Hi everyone, and welcome to the next episode of the HeelanHub podcast, the show for small business owners. I'm Dan Heelan, and on today's show, I wanted to talk to you about some strategies that we use with our clients as business accountants that can sometimes feel a little bit scammy, or you talk to somebody about it, talk to a client about it, and they go, that can't be true. You're like, no, trust me, it's true, and it is kind of legal. No, it's absolutely legal. Of course it's legal. We're regulated accountants, so we only talk about things that are legal. But it's just that knowledge, again, of the way the tax laws work to achieve some goals. So for me, the four that I want to focus on today are really based around, look, obviously we want to reduce tax. And I always say this, and there's a sign behind me if you're watching this on our side YouTube channel, that says tax is a success fee. I'm a big believer in the fact that if you do well in this country, you're going to have a tax bill problem. But it's a nice problem to have because it means you've done well. Successful people are always going to pay tax. The game and your mission as a business owner, from my viewpoint, is only to pay the right amount. Everybody else in employment pays the right amount. So why should a self-employed or a small business owner pay more just because you don't know what's possible and you don't know how to arrange your affairs? It's not about scamming the government. We've all got to pay tax. Anyway, this isn't a political rant, but we've all got to generally pay tax, otherwise stuff doesn't function right. But we shouldn't be paying more than our fair share. So reducing tax, obviously important, but also maybe delaying when we have to pay tax. Now that's quite a big one and often overlooked because as small business owners, cash is our lifeblood. You know, we want it coming in, we want to be able to pay for things, and you want that to be able to operate your business, to grow, to hire people, create jobs, better the economy, all the other things. So delaying paying the tax is also quite big, and just keeping that cash for longer. So when I'm talking about these strats, that's what got me thinking about this. I was like, well, where do we see some magic for those? And that's what we're going to talk about in today's show. So let's get on with it. So two of these strategies are going to be really only for use in a limited company, but I think it's worth listening, even if you're not a limited company, just because you can see, like, there's a good example of why it might be worth thinking about going into a limited company. And two can absolutely be applicable. It doesn't matter if you're a partnership, a sole trader, whatever the case, it's going to be applicable to you. So let's talk about one of the limited company only strategies to begin with. And that's one that when I explain it, there'll be, and I know accountants listen to this, so if it's you, hello. I know because I bump into them at trade shows and they say, oh, I listen to the podcast. They will probably cringe when I talk about this one because it's fraught with danger. And it's just worth saying this, that before you do this, make sure you fully understand what you're doing. But I want to tell you that it exists. And that's that you could just borrow money from your company. So instead of paying yourself a wage, you could potentially borrow some money as a director. And again, always in these videos, I'm talking as if you're the sole, well, not necessarily the sole director, but you're the owner or one of the small amount of owners in what they call a close UK company. You know, you're the director and it's your small business, right? But if you wanted to borrow money from your company, you can actually borrow up to £10,000 without any immediate tax issue. So if you borrow £10,050, then you might have a benefit in kind issue because you've had basically a interest-free loan provided to you, and there can be a personal tax consequence for you, and there can be a company tax bill of up to, well, it's not up to, it is 15% of that, the benefit. So there's a calculation you do basically on the loan balance that says, well, that's really the interest that you didn't pay, and therefore the company needs to pay 15% national insurance on it as well. So it can get quite pricey, but up to £10,000, that doesn't exist. You can borrow that. So as long as your loan never exceeds £10,000, then you can borrow it without having these extra taxes. Now you might think, okay, but surely I'm going to pay tax on it at some point, and you are, and we're going to talk about that. But it can be very useful if you only need a temporary amount of cash. Now, example, say you're a director and you've already taken around, between your salary and your dividends, you're at nearly £50,000. So that's when you go over £50,000 in a tax year, you start paying the higher rates of tax. So for your dividends, that's going to be in excess of 35%, or if you're being paid salary, it's in excess of 40%. It's 40% plus national insurance potentially. So there's a big steep jump between basic rate and higher rate. So to picture that with your dividends, you jump from 11 and a bit percent to 35 and a bit percent. So it's quite a big jump. But say you want £10,000, or let's say it's £9,995, and you want to go to the Maldives on that like super holiday for your birthday. I don't know. I mean, I'm not a massive holiday goer. I've got no life. But if for you might love that. You might look good for the gram, and you want to go on holiday. Now, if you just took that now, you're going to pay those high rates of tax. So if you took that nearly 10 grand, £3.5 grand of it plus is gone in tax the minute you do that. But in a scenario where maybe actually next year you're going to take a bit less, say, maybe it was actually, this was an exceptional year for you and you don't normally take 50, you normally take 35. So you expect to take 35 next year. Well, what you could do is you could take a loan. So let's say we're actually in January of the year and or February, we want to make a decision. That £10,000 that we take in March is going to end up in the higher rate because we're still inside the tax year. What we could do is we could borrow the £10,000 from the company. So we're not paying any personal benefit in kind tax because it's under £10,000. And we're not paying any income tax because we're loaning it to ourselves at this point. So great. Now, what will happen is you can then use that loan. And then what you can do is on paper, presuming your company's got enough profits, and this is where things tend to get tricky when you do this, so you have to plan it appropriately. But let's say your company's still making loads of money, it's all fine. You could have taken that as dividend at the time, but you chose not to, you took it as a loan. When it ticks over to the next tax year in the 6th of April, what you might do is you might then make sure all the paperwork's in place to declare yourself a dividend for the £10,000, but it's in the new tax year. So the minute of the end of tax year, the minute you have it, it's a loan, and then you wipe it out without any money changing hands. So that's the bit that sounds scammy. You're like, what? So I've had £10,000 and I don't have to, as a loan, and I don't have to repay it. And the answer is kind of yes and no. Well, you are technically repaying it on paper because you're having a dividend. You're basically saying, I'm now having the £10,000 in taxable income. And if you do all the paperwork right, it gets taxed in the next tax year. Now, what that would be is if you imagine you had nearly £3,500 of tax if you'd have declared the dividend in the previous year, because you would have been into like £60,000 worth of income. But in the next year, if you presume that you're not going to reach it, so say you were going to earn only 35 grand, and then you declare your 10 grand, you've only got 45 grand of income. So you're still in the cheap rate. So your tax bill might only be about a grand. So actually you've saved about £2,500 by loaning yourself it for a temporary point and paying it in the next time. The other big thing about this is even if, because you might be like, well, okay, but I know I'm going to still be over 50 in the next year. So you think, what's the point? Well, the point is, if we declared it, so say we're doing this in, let's say 26. I know this, if you're listening to this, I've recorded this after 5th of April 26, but let's say you're borrowing it in March 26. Now, if you didn't, and you declared a dividend, your personal tax payable on that dividend would be due on the 31st of January 2027 for the majority of you. If we declare it, if we borrow it for a bit and declare it as a dividend after the 6th of April into the next tax year, it's the 31st of January 28. So it's an entire extra massive period that you're going to be able to hold on to your cash. And I mean, hopefully you'll be in a position where you can pay that tax and everything else. So this is where I was saying it's risky because you've got, so that there's some risk in it. If you're confident of your trading position, your business, you know you're making good money, it's all planned, you know where you're at, it's completely fine. It's actually a very good tactic that can work and a strategy that's proven time and time again to save some tax or at least delay paying it. Where you can get in trouble though is if you don't pay it. So, for example, the rule that the loan struggles with is, let's say you couldn't repay it because on paper there wasn't enough money to have a dividend. So in order for a dividend to be legal, I've done loads of different podcasts on this, you have to have enough retained earnings, retained profits in the company, which is normally, if you're making loads of money, it's fine. You'll notice there's something called a balance sheet. It's one of the financial documents that your limited company will have, and it will show you an amount of, sometimes it will say shareholders' funds or retained earnings, that kind of terminology. And hopefully, by the time you've taken into account any future tax, depreciation, things like that, if you were to look at your accounts, you can see whether that dividend's due. Now, if the dividend's due, it's fine. But if it's not due, because maybe you had a downturn, or maybe actually you've just robbed the tax money from the account, which is a more common one, someone will drain the account, and they should at any one time really be able to pay their tax bill, or at least have enough funds somewhere. It might not have been paid to you yet. It might be a customer invoice, customer owes you money, but somewhere on paper, the company should have that tax money. That's effectively what's happening. And sometimes it just doesn't. Sometimes you're just taking too much money, or you've had a downturn in business, and that's where it gets dangerous. Because the minute you take the money, what happens is you can go all the way around to your company year end, and that can be any month year end. You can just look it up on your company's house. And you've got 9 months and a day to either clear that money with a dividend or salary or something like that, or you have to physically repay the money, which obviously we don't want to do because we've spent it on our beautiful holiday. And that's where people get in trouble and struggle, is because if you don't, you end up with a tax charge of roughly 35%. So they look at it, HMRC basically say, well, you've borrowed this money, so what we're going to do is we're going to charge you the same rate that you would have paid if you were paying the higher rate of tax, and your company is going to hand that to us. And we'll tell you what, when you do actually repay that loan via dividend or salary or other method, you physically repay it. Once a certain time limit's existed, we're going to give you the money back, because actually, company, you're only paying it. It's not your fault. You're basically paying it on behalf of that director, shareholder, who's nabbed the money out temporarily. And the reason they do this is because otherwise people would indefinitely borrow from their company and pay no tax. And actually, there's many schemes, and footballers were one of the ones that used to do this, going back years, that were proven not to work, that were on this idea of you just endlessly borrowing money and never repay it. So, but this charge exists to stop a lot of that happening. So you don't want to be there, because what tends to happen is you get into this horrible cycle, and it tends to just get worse and worse and spiral. So this is why it's a strategy that only works if you're really in control of it. So your loan has to be repaid within 9 months and a day after your company year end. Otherwise you pay that charge. But as I said, the charge is reclaimable, so you can get it back. But the reason I say don't do that unless you have to clients is because the time limit for actually when you can reclaim that money is a lot further ahead than you think. So you'll be like, oh yeah, I've repaid it, cool, I'm going to apply to the tax office to get my money back. And they're like, no, we need to see your entire account's filed, and it needs to have gone past the due date at which your next tax bill's paid. And then we might consider it. And even then they could be a bit funny about it, depending. So if you can avoid paying that additional tax charge, then you will, absolutely. But in the simple scenario where you're just borrowing under 10 grand for a small amount of time, and maybe you're holding it over between 2 tax years, can work out really, really well for just either reducing it or reducing the tax, or delaying when you've got to pay the tax. So that's the first one, borrowing from a limited company as a director. Now, the second one, this one, whether you're a limited company or not, applies, and that's buying assets. So that's normally big stuff like vans, laptops, those kind of things that qualify for what's known as capital allowances. Now, depending on how you do this, some sole traders this can work for, some can't. But what you would do is you buy something known as capital allowances, and actually it works very similar for sole traders depending how they do their accounts. So some of you who are a sole trader might do your accounts and you won't actually claim capital allowances, but the way the cash basis works means that it will feel similar. But let me explain. So let's just presume you're either a limited company or you're doing your accounts on like a traditional basis where you can claim capital allowances. Now what that means is you buy, I'm going to use a van in this example. Now, I think I did a recent podcast, certainly done some videos on it, talking about the fact that not all vans that look like vans actually count as vans for tax reasons. But let's say you've got a van, it's got, only a front row of seats, it's all panelled, big white transit van, there's no rear seats, no windows, nothing like that. It's a van, right? And if you do want to know more on that, go check out the other podcast. So it's going to qualify as a van. Now, what you might do with it is you might decide to finance it, because what generally happens with something like a van is it counts as what they call plant and machinery. So you can claim a capital allowance. That capital allowance lets you offset the entire cost of the vehicle in the year you buy it against your profits. Now, let's just say that again. So your taxable profit, so say you made 40 grand and your van's 40 grand. Now you haven't paid the whole 40 grand if you got it on finance, but they will allow you to say, right, that 40 grand, you can knock off your profits. So your tax bill was calculated on you earning 40 grand. Because you bought the 40 grand van, there's now no taxable profits, no tax. Or, if you did have some, it's just going to massively reduce your taxable profits. It doesn't mean that the tax bill is free, like you've just generated 40k, it's just reducing your tax bill. But I just want you to picture that concept, though, that it's basically reducing your taxable profits, massively reduces your tax bill. So let's take an example, actually. Let's just say the van costs 45 grand and you purchased it on finance, traditional hire purchase. So you technically are going to legally own it at the end of the 5 years, and it's going to qualify for annual investment allowance. Now, you're going to be able to deduct the full 45k, as we were saying, as annual investment allowance. And if you're in a company where you're paying tax, say 25%ish, that's going to save about 11 grand's worth of corporation tax when you do that. Now, what you can do is, because of the finance, if you think about it, you might only, depends on how much the finance costs you each month, how much deposit you put down and when these payments are done. But in several scenarios where I show this to clients, is you might have only parted with about 6 grand of cash, but you've saved 11 in that year. So it can be quite good. You get for your 45 grand deduction and you've only paid 6 grand for it in that year. Now, of course, you've still got to carry on paying for the van and all your relief's front loaded. So you've got it in the year you buy it. But often, again, that's quite good for just cash flow. You're just delaying it. Now, as always, and this is, if you've listened to me for any time, I'm gonna say this, you shouldn't spend money just to save tax. So in this example, I'm going to presume my client wanted the van. They needed to replace a van. It was the best thing for them. They'd factored in all the different running costs of a van, and they're happy that it's diesel and it's going to cost a fortune, and these emission zones and all the rest of it. Let's just presume that's all in place, and we're going to spend it anyway. Then they were just looking at, well, what's the best thing to do? And and I've done other podcasts on leasing versus buying, often there isn't an easy, obvious answer. Actually, both will fit the bill. But if you want this type of relief, you normally need some sort of hire purchase or a loan, just a straightforward loan for the van, that kind of stuff. Where it doesn't work is if you're going to actually lease it, because that's not quite the same. Although even in a hire purchase scenario, you might not count as legally owning the van until you pay it all off. For tax purposes, they call it like the risk and reward of ownership. So you might actually count, you normally will count as actually owning the van. The takeaway here is if you're going to buy something like a van at that kind of money and you're going to get finance, it's worth talking to your accountant if you've got one about, is this finance okay for me to get my capital allowances, or particularly what we're calling annual investment allowance here, because that's the one that we're playing around with. Now, this kind of thing does work with smaller items. So you could buy like a MacBook on finance. The problem with it is when you do the scenarios, often you don't get that same kind of cash flow benefit. Like, it's okay, you're still not parting with loads of cash, but if you look at the actual tax saving you're getting, it's not as impressive sometimes as a big van because of the way it's going to work. But the concept is still the same. So that's good. And any interest on the payments is also going to be tax deductible and help reduce your profits. So again, with tax deductible, it doesn't mean the interest is just free, like it's being paid for by the tax, but it means that effectively, if you're a limited company, that interest being charged might actually be about 25% less, depending on what rate of tax you're paying, because of the way the tax relief works. But so yeah, just know you get relief on the interest usually. So again, things like vans, MacBooks, forklifts, most of what they call plant and machinery. So yeah, main takeaways on this one is that it will always improve your tax position, but it might also help your short-term cash flow. So that's how that goes. But do check on the finance of that one. You want to make sure that you've actually got the right finance. Now, the third strategy, this one again is limited company based, back to that now, and that's employer pension contributions. So unfortunately, as a sole trader or as a partnership, you paying into your personal pension, if you're a higher rate taxpayer, you're going to get some relief on your tax return because the government's only topping up 20% in your pension pot usually. And if you pay tax at 40%, they're going to give you that extra 20% they should be topping up in your tax return. It actually generates a refund sometimes. So that's okay. But from a limited company owner's point of view, if you do that, you will have paid corporation tax to have made the profit. And then the after-tax profit, you're then taking out and paying income tax to pay it into your pension for a top-up. What tends to be far more efficient is that you decide, as the owner, you're going to pay into your pension as your employer. So your company is going to pay into your pension as your employer. And it's no different to if you were employed, actually, where if you ever had a job being employed in the days, either back when big firms used to offer pensions or now when nearly everybody has to, then you would have had a small amount that you would have contributed and you would have had the employer, so your company, your employer's company would have contributed a small percentage. The important thing here is that it doesn't have to be that. It doesn't have to be you contribute, company contributes. It can just be company contributes. So you as a small business owner, you normally don't want to pay any personal tax on the contribution, so you're going to have the company do it. So I'll give you an example. You could pay, like, for most of you, you're going to have about £60,000 a year in pensions at the time recording this podcast that you could pay into your pension. And actually, if you've not paid any in previous years, you might better increase that limit. There is a scenario where that limit starts to drop if you're earning megabucks, but for most of you, most of our clients, that's where we're going to be. Now, if you paid 60k, it's going to reduce your profits by 60k, as we said. So that's a corporation tax saving of probably around 15 grand, and also moved that 60k into your hands. Now, the downside, of course, is that it's in a pension. You might not like pensions. I'm an accountant, and me talking to you about whether a pension's a good idea is regulated financial advice, which us mere accountants aren't allowed to do. It's in the remits of financial advisors. Weirdly, we can talk to you about what you should do with your business money and, your budgets and your cash flows and all the rest of it. We just can't talk to you about whether a pension's a good idea, but I can tell you from a tax perspective, it's quite good. So presuming you're comfy with the vehicle, if you like, with little bunny ears of the pension, that's fine, but it is a pension, but it locks it away, of course, so you can't touch it until you're in your 50s or whatever. So it's not like it's a long-term play, not a short-term gain, really. So that's important. And I think the twist here as well of the one, because that you might think, well, doesn't sound very legal, Dan. I've heard that before. You've talked about it about a million times. I'm like, yes, I have. I think the bit that often gets overlooked, though, is if you're in a small business and you employ other family members, they've also got pension allowances. So you can do the same for them. So spouses, children, other family members, those kind of people, if you genuinely employ them, same sort of thing applies. And it's worth looking at structuring that, because again, it can be a nice way to plan, particularly like generational wealth, planning wealth future down the line, if a pension is for you. Now, there's been some inheritance tax changes recently, so some people are looking at pensions a bit more speculatively than they might have before, but that's definitely still a strategy. Loads of owners still do it. They normally do it as like a mix. So they might do some into the pension and some into something else, some personally, maybe they're invested in property or something else. They'll do a wide range of things, but the pension's normally part of that planning because I think most people understand it. And from a company point of view, it's quite good. So there we go. So, and for me, the key is always with this is actually you're moving money into personal names and you're doing so whilst getting tax relief and it's not costing you personal tax. So it's like a double dip. It's quite nice. Immediate personal tax anyway. Now, when you take it out further down the line, there's going to be tax, but that depends on the rate of tax you could be paying at the time. Because if you've only got a small amount in your pension and you've got no other income, it might be you pay no tax. So who knows? But that's there. So for me, the main takeaway on that one is to investigate whether that's right for you, because it is one of the easiest ways to reduce your corporation tax bill if you're into pensions, basically. And then the fourth one, and this one's for anybody, and if you've listened to me for any time, it might not be a surprise, but it's keeping better digital records. Now, this one, the reason it's easy to understand is that it's boring and it's kind of obvious, but people overlook it all the time. And that's that, let's say you attended a training course, you travel to the training course, let's say you had to stay away. So your travel to there, your meal, your hotel receipt, all that is likely to be subsistence and travel, be fully claimable and tax deductible. And let's say while you're there, you pay for the dinner in cash because you had some spare in your wallet. You lose the receipt. Now, the chances are, when it comes around to doing your tax return, if you're a sole trader or if maybe your company, you're a bit more up to date with it, I don't know, and you've lost the receipt, and it's not recorded anywhere, is it? There's no prompt for you to remember. You've lost the tax relief altogether. And I find that, it's not particularly, it's not a surprising strategy, but I could not mention it with the other three without just reminding you about how powerful this is. Because if you see what we see and you see the amount of things when you talk to an owner and you're like, what about this? What about this? What about this? They're like, oh yeah. And then we're like, you've driven, not always, because many of our clients are all over the world actually, but certainly all over the country. But for some of them who are local, if they travel to see us, it's like things like, well, oh yeah, have you recorded your mileage to come and see us? Because that's a business journey. And they're like, no. Okay, well, that's worth a few quid. Oh, and while you're here, did you buy lunch? Oh yeah, of course I did. Okay, like it adds up. So making sure that you capture all those receipts. And the biggest thing here, the biggest tip and takeaway is to use technology. So obviously a big fan, as many of you know, of Xero. That's Xero with an X. It's an accounting software. All sits in the cloud. There's an app for your phone. That has receipt capture technology in it. My personal combo, I like those. I use Dext, which is a third-party add-on that joins up to Xero just because the automation's better. Obviously, it costs you a bit more because you're paying for Xero and you're paying for Dext, but they're good. If you do fancy, by the way, a Xero license to play around with and trial, if you go to HeelanAssociates.co.uk/Xero, there's a crazy discount. I think at the moment it's like 95% off for 6 months, even if you test it for 6 months there. But the big thing there is don't click on trial because it'll give you the option for trial. You don't want a trial. You want to buy it for cheap and then see if you like it, really. Full disclaimer, of course, we get a kickback, help support the show, but Xero is absolutely what the vast majority these days of our clients use. So it's not being a shill. It's literally what our clients use, especially since QuickBooks destroyed their graphical interface, because that was quite good as well. And it's still a good product, but anyway, that's another show for sure. But there's other receipt captures out there. There's things like Apron, HubDoc. I think auto entry might still exist. So there's a few other ones out there, but for me, Xero and Dext is the combo. But Xero itself has a way to do it on its own, and it also comes bundled with HubDoc, which is another separate app that's kind of like Dext but not quite as good. So that one can also work. So the main takeaway on this one is just make sure that you capture in your receipts. So before you walk away from the till, snap the receipt. And I know I have to do it. I annoy people. If you ever see me in Starbucks, I will be there snapping my receipt before I leave the till because I'm a nightmare and my team shout at me. So every missed receipt is obviously potentially tax relief that you're just throwing away. So there we go. So for me, bit of a recap then. Tax plan is not just about, what can we reduce and how do we structure things? Obviously, that's quite important, but it's about making sure when are we going to pay the tax? What might we delay when we pay it? How might obviously we reduce it, and just keeping more money in the business so that it's available for growth. And of course, usual disclaimer with anything with tax, there's loads of criteria, anti-avoidance rules, like with directors' loans, there's things they call bed and breakfast in rules and all this to stop you doing silly things. I was going to swear them, but playing silly people with the different rules. So do get them checked out. You can obviously ask AI, but it tends to miss a lot of these. So do speak to professionals or your accountant about them. But yeah, so as always, broad education, not investment advice. Do your own research. That's it. Now, I think that's everything I needed to tell you about today. Hopefully that's going to give you a bit of a feel for some things that you could check out. If you have enjoyed the show, please do subscribe via your favourite app so you don't miss an episode. We also put these shows up on a side YouTube channel. So we've got a main one at Heelan Associates. So we've got probably 300 odd videos, although we've delisted some now, but there's hours and hours of content on pretty much every topic on small business tax and accounts and bookkeeping that you can think of. As check that out. But we also record these at the HeelanHub on the side one, and I'll go in every week and read the comments. So do engage away there. It's lovely to read it, because when I record these, I literally record it against the brick wall, and I hope someone's going to listen. We know statistically lots of people listen, but it's nice to interact with people in the same way we get to on our main YouTube channel. If you have enjoyed it though, do subscribe. It helps us keep that visibility on your favourite app. I know a lot of you come through Spotify. For more business insight and tax tips, be sure to connect with me and my great team across all the social media channels, including, of course, LinkedIn, Instagram, YouTube, Facebook, Twitter, and TikTok. You can also sign up to our 2-weekly HeelanHub Herald, which is an email direct to your inbox, which contains even more business insight and tax tips. And you can do that if you just go to heelanassociates.co.uk, scroll down for a bit, you get a pop-up and you can sign up there. If you want to get in touch about the podcast, and I know a few of you have recently actually, so if you've got anything you want to see covered on the show, or you just have any comments, you can do that at info@heelanassociates.co.uk. Just put podcast in the title and it will reach me. One of my team will make sure it hits. That's it. Have a profitable and tax efficient week, and I'll see you in the next one.